Extending guarantees on funding, whether retail or wholesale, is another way to make creditors believe that they will get their money back, as are measures to insure or quarantine the risky bad assets. An open question is therefore whether the banking system will be able to support an adequate volume of credit as the extensive network of public support is eventually removed. If not, then further attempts to deleverage are possible. And deleveraging through the restriction of new loans generates a positive feedback loop analogous to that through asset sales. Deleveraging by restricting credit growth may be privately rational, but if every intermediary tries to do the same, the result will be lower activity and higher defaults and little improvement in leverage ratios. What, to paraphrase Keynes, we might describe as the paradox of deleveraging. Let me now turn to the lessons from the crisis regarding the conduct of monetary policy in the future. In the run-up to the crisis, there was a lively debate regarding the right way to respond to rapid credit growth and rising asset prices. On the one hand, economists at the Bank for International Settlement and others advocated leaning against the wind by raising interest rates above that apparently warranted by inflation and activity. On the other hand, the Federal Reserve under Alan Greenspan espoused a policy of benign neglect, coupled with aggressive relaxation in the event that asset prices fell sharply, on the grounds that identifying an asset price bubble in its early stages was difficult, and trying to deflate an established one was dangerous. Well, the events of the past couple of years have clearly tipped the balance in favour of taking preemptive action. But monetary policy is a blunt weapon, and raising interest rates enough to cool a credit asset price boom that's in full swing is likely to involve substantial collateral damage to real activity. Instead, with an additional objective in the shape of credit growth or asset prices, one needs another instrument that has a stronger and more direct impact on credit growth and asset price inflation than does monetary policy. And that's what so-called macroprudential regulation is intended to achieve. Now, most of the discussion of macroprudential regulation in policy circles has revolved around introducing pro-cyclical capital requirements or its close cousin dynamic provisioning. Thus, banks would be required to build up extra capital or reserves during a credit asset price boom that can then be run down in the event of a bust. And this should reduce the incentive for banks to leverage up in a boom, as well as making the financial system more resilient in a bust. However, other instruments could also be deployed. For instance, credit asset price booms seem to be characterized by an excessive shift into riskier forms of lending. In that case, an instrument more directly targeted at the microeconomic distortion would be to increase the risk weights that are attached to such lending when computed banks' required regulatory capital. And as we've seen in the present crisis, a lot of the action has actually taken place outside banks' balance sheets. In that case, varying margin requirements might be a more appropriate instrument for dealing with vulnerabilities building up in the capital markets more generally. After the instruments have been identified, a host of other questions then need to be addressed. Precisely which variables should the instruments vary with, and how the variation is supposed to be calibrated. And once that's been answered, policymakers need to understand both the macroeconomic impact of the instruments and how their operation interacts with monetary and fiscal policies. Everything I've said so far about macroprudential regulation has been couched in terms of moderating the impact of the credit cycle over time. But the earlier discussion of network effects highlighted the potential role played by large and highly connected financial intermediaries. That points to another role for macroprudential regulation, namely to increase the robustness of the financial system by requiring systemically important intermediaries to carry heavier capital requirements. And this cross-sectional dimension adds another set of instrument design issues. Let me conclude with some observations regarding the implications of the crisis for the future development of our subject. In all probability, the Great Panic and the Great Contraction of 2008 will join the Great Depression of the 1930s and the Great Inflation of the 1970s as discipline-defining events. The struggle to understand and deal with the Great Depression led to the invention of macroeconomics as a distinct branch of the subject. In the case of the Great Inflation, economic theory for once led in them events, with the development of the natural rate hypothesis foreshadowing the subsequent takeoff in inflation. But the subsequent decades were spent with refining our understanding of the inflationary process. What will be the legacy of the Great Panic and the Great Contraction? Well, first, in my view, it would be a mistake to look for a single guilty culprit. Underestimation of risk, born of the Great Moderation, loose monetary policy in the United States, and the perverse pattern of international capital flows, together provided fertile territory for the emergence of a credit asset price bubble. The creation of an array of complex new assets that was supposed to spread risk more widely ended up destroying information about the scale and location of losses, which proved to be crucial when the market turned. And an array of distorted incentives led the financial system to build up excessive leverage, increasing the vulnerabilities when asset prices began to fall. As in Agatha Christie's Murder on the Orient Express, everyone had a hand in it. Second, the economics profession has oversold the virtues of unfettered financial markets. We usually start from a presumption that markets work best when they're left to themselves, unless there are obvious market failures present. By the same token, even though not strictly the case in theory, we usually start from a presumption that expanding the range of available securities is beneficial. Yet that has clearly resulted in a deeply unsatisfactory outcome. Now, one view is that we need to bring psychology and the insights of behavioural economics into the study of financial markets. Now, that may indeed be part of producing a richer and more accurate description of financial market behaviour, particularly in regard to expectations formation. But as I hope my lecture this evening has made clear, distorted incentives, information failings, collective action problems, and network effects have played a large part in recent events. Our standard analytic toolkit should get us a long way in understanding what has happened.